This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the AJ Bell Money and Markets podcast. I'm Dan Coatsworth, and this week I'm joined by Charlene Young and Tom Sieber. Hello to you both.
Hi Dan, hi Tom.
Hi there.
So we've got a pretty packed show, so let's jump straight in. So first up, we're going to explain why there's been a sell-off in UK government bonds. We're also diving into a big story about 7 investment trusts where retail investors are being asked to vote on their future. Yes, you heard that right. It is democracy in action for shareholders.
Yeah, and behind it all is Saba Capital, the activist investor making waves by calling for board shake-ups and wanting to take over management of these trusts.
But not everyone is on board with Saba's plans. We'll be hearing from Sue Inglis of the Baillie Gifford US Growth Trust for her take on the matter. It's going to be a fascinating discussion.
Yeah, and after that, we'll bring you up to speed on what's happening in the UK retail sector. So we've had quite a lot of data out on what's going on, and quite a lot of the companies have started to report as well. So we've got some interesting nuggets on Tesco, Next, Greggs, Marks and Spencer. A bit of a spoiler alert, shopkeepers didn't have the best end to 2024, and things are not looking too rosy for the year ahead either.
Yeah, I'm going to take a look also at the latest energy price cap figures and forecasts and kind of have a look what's behind some pretty grim numbers.
And if you've got a lifetime ISA, you should listen out later on in the show because the government's just called for a review and we're going to explain exactly what's going on there.
So finally, Danni Hewson's been chatting to Dominic Weller, who's the fund manager of the UK Future Generations Fund from Octopus, about whether investing for change can also come with chunky returns now that interest rates are slowly on their way down.
Right, let's kick things off then. And we've had some big news in about kind of a government bond sell-off in the UK here and further weakness again in the pound against the US dollar.
Yeah, so quite a lot to get your head around here. So really, it's kind of the market sort of implying it's sort of losing confidence in the UK government. We had the 30-year gilt yield, so UK government bonds, that briefly hit 5.445%. That's much higher than what we saw during the short period where Liz Truss was running the country, and there was a bit of a sort of a crisis in the government then. The pound has also slumped to $1.2256 against the US dollar, so that's the lowest level since November 2023. So I think what we've had here is we've had a general election last summer. There was a bit of a feel-good factor about the UK. Since then, that sort of sentiment has completely changed. People are getting a bit worried about the job security. They're worried about cost of living potentially going up again. Companies are bracing themselves for higher costs, all because of things that have been decided in the budget in October. So now investors are worried that the government is going to have to potentially borrow even more money to achieve its plans. So it's in a sort of a slightly sort of sticky situation here. In rising gilt yields do have a direct impact on the government's fiscal headroom. Climbing debt servicing costs have put the Chancellor's fiscal rules under threat. So I was reading some stuff from Capital Economics just before this podcast, and they were saying that this spike in the market borrowing costs that we've seen in recent days, it's effectively wiped £8.9 billion off Rachel Reeves' £9 billion spending buffer that was featured in the budget. So it thinks that makes further tax rises and spending cuts more likely. So, of course, the Treasury said that meeting these fiscal rules was not negotiable, kind of implying that Reeves have no choice but to raise tax or cut spending to cover a shortfall. However, there's also been a reiteration that there'll be no further tax changes in the spring statement that we'll get on the 26th of March. So I guess, where does that leave things? Rachel Reeves might have no choice but to shrink public spending budgets further or impose cuts to sort of the growing welfare budget. So all in all, it's perhaps not a great start to the year, all this sort of volatility in the markets, but no doubt this is it would just it will bubble along and things will get worse until we get this spring statement. Effectively, I'm not sure we can call it a mini budget these days, but end of March is sort of going to be a real tipping point for Rachel Reeves to sort of update on where things are going.
Thanks, Dan. Yeah, no mini budget talk, please. No mini. Absolutely not. So kind of onto investment trusts that we mentioned in the intro there. So we've seen 7 trusts come under the spotlight after Saba Capital's campaign to shake things up. Dan, can you tell us a bit more about what's going on and what Saba are actually calling for or what they plan to do?
Yeah, so Saba is like a US-based activist investor as a hedge fund. It wants to replace the boards of these trusts and essentially become the new manager because it argues it can deliver better returns for shareholders. Naturally, there's been a bit of a pushback from the current managers and the current board of directors. And I guess, it's not just all about performance, it's also about control. Saba's saying it's going to unlock value for investors, but critics are arguing that these plans are far too disruptive and they might not be in everyone's interest. So I guess when I was looking at them, I thought, actually, are these sort of the types of trusts that people might have in their portfolios? Whilst they're not the most, perhaps the most well known and sort of the most popular, they are really widely held amongst UK retail investors. So it includes names like Baillie, Gifford, US Growth, Edinburgh Worldwide, Herald Investment Trust, and Keystone Positive Change. So all of these have, depending on the periods that you're looking at, have shown to either be lagging their benchmark index, what they're trying to be compared against for a while, or they've got really wide discount to net asset value, which essentially means they're trading well below the underlying value of their assets. So, activists would normally come along and sort of saying, look, we found something cheap and we can potentially close that gap and make these things trade much closer or at fair value. It sounds easy on paper, but then it's never easy to do. So what's happening here is that these shareholders are being asked to vote on 2 resolutions. First is to remove the current directors. The second is appoint new directors of Saba's choice. So essentially what would happen is if Saba wins, it would come out with lots of new proposals on what to do, how to change things, potentially merge some of these trusts with other trusts, also look at things like tender offers and share buybacks. So I guess if you're a shareholder in them and you perhaps a bit frustrated by performance over a shorter or longer period, you might want to sort of take a closer look at what Saba is saying. However, there's been lots of people, not just these trusts themselves, but also sort of industry experts are saying, it's not a sort of a simple situation here. It looks like Saba's being really opportunistic, trying to seize control without actually being sort of a major shareholder. So, Tom, you write about the stock market a lot. Have you ever seen activist investors come to the investment trust space in this sort of level?
Not at this scale, no. I think Saba has done something similar in the US, hasn't it? But obviously there are closed-end funds in the US, but they're quite different from UK investment trusts. So it's a kind of different, it's playing in a different arena, I guess. But no, this feels new. And I mean, I think there's been some speculation that Saba might not stop here as well. It might not stop with these 7 trusts. So it could become a theme that sort of persists beyond sort of the short term. Because I think the meetings that have been requisitioned by Saba, they're coming up, aren't they, Dan? They're not too far away.
Yeah, so I mean, we've got nearly all of them have sort of been confirmed now, just waiting for one as we're recording this. But essentially, Herald kicks things off on 22nd of January, and then it's mostly between the 3rd, 4th and 5th of February. We've got these dates where these are sort of extraordinary meetings are being held. Now, I think it's a really important thing to stress here is that if you own any of these trusts, it is important to cast a vote because essentially if you do nothing, if no other shareholder votes at all, Saba will essentially win automatically. It's put forward these proposals as ordinary resolutions, which means it needs a simple majority or more than 50% of votes cast to pass at the EGM. So now this hedge fund already owns between 19 and 29% of each of these trusts. And of course, it's going to vote in favour of its proposal. So it does mean that if you have, let's say, it owns 20% of a trust, you'll need to have opposing shareholders representing 20% and at least one more share to block it. So I think what will happen over the coming days, anyone that holds these trusts should receive a message from their platform provider, such as someone like AJ Bell, and it will say, "This is these confirmed resolutions you have to vote on. You've got this amount of time to vote." Now, whilst the EGM dates are very clear, if you're doing proxy voting, voting online, typically that needs to be submitted a couple of days beforehand, before those deadlines. So hopefully all this information will be sent to you and clearly marked exactly when your deadline will be to vote. So now, interesting, AJ Bell recently launched a new service for electronic voting, meaning people can vote online for this, and it's fairly simple to do. So ultimately, voting really gives you an opportunity to have a say on how an investment trust will operate. Ultimately, that can influence performance and investment. So I think it's really important to get involved. And just to give you a bit of an idea about some of the sort of the issues that some of these trusts are thinking about, I actually spoke to Sue Inglis, who is a non-exec director from one of the trusts, which is Baillie Gifford US Growth Trust, a couple of days ago. So this is what she had to say on for her perspective on where things are at the moment. So Sue, thanks ever so much for joining us. The first thing I just wanted to ask you was trying to get the context of, have you actually met anyone from Saba to discuss their proposals? I was just wondering how this sort of campaign started. Is it literally just them sending you a letter saying this is what we're going to do, or have you actually had a proper discussion with them?
Certainly the current campaign by Saba started with that letter being sent. But I think putting it in context, we actually as a board met with them twice last year. So the first time the chairman met with them, and then both the chairman and myself met with them in November. And at those meetings, nothing of concern was expressed by Saba regarding the running of the company, the management, the performance, the discount management, or indeed the corporate governance of the board. So It was a surprise then to receive that letter from them.
Yeah. I mean, are you surprised that Baillie Gifford US Growth has been targeted anyway, given, I guess, if investors bought in at the start when it floated in 2018, they would have nearly tripled their money. Last year, the trust did beat the S&P 500 index by about 6 percentage points. So on that basis, you would have thought that shareholders, certain shareholders, been in for the start, being pretty happy. So are you surprised that Saba's sort of approached you in this way?
Yes, I think it is fair to say we've been surprised. As you rightly point out, our long-term performance is very strong, and that places us among some of the best investment trusts in the sector. Likewise, our short-term performance is very strong, and in the last year we've outperformed the S&P 500 by 6 percentage points. That said, our 3-year performance, which is the one figure that Saba is focused on, is not strong. And that is a result of effectively a weak period of performance, about 18 months, having come out of COVID. And we're not a short-term investor. We've been clear that we are long-term, investing over 5 years plus, and we don't manage the short-term volatility. And I think that approach has been validated by the fact that our short-term performance has recovered and our long-term performance is also very strong.
Yeah. I mean, just on those 3-year figures that Saba have been quoting, so 13.8% 3-year average discount to net asset value, 52.8% underperformance versus the benchmark. So, I mean, just as a board, were you already discussing that sort of underperformance before Saba came along, or do you think actually because it was coming out of COVID, it wasn't necessarily sort of a worrying issue to focus on?
No, as a board, we constantly review both investment performance and discount. And in aftermath of COVID, we had some pretty deep thoughts and analysis done on what had gone right and what had gone wrong. Because obviously during COVID, our performance was very strong, and then in the aftermath of it, it fell away very strong. And as a result of that sort of review and debate, and that involved the managers as well, we have made a number of refinements to our investment processes. And I think that's what you're seeing coming through the last 2 years in our improved performance. As far as the discount is concerned, I think putting again in context, before COVID, we had been trading consistently at a premium since IPO. That turn in the premium to a discount, I think, reflects sort of combination of factors, but in particular, these sort of change in sentiment towards growth investing and our drop in performance. And, we debated share buybacks. We consulted with shareholders on approach to share buybacks. And we have bought back about 6% of the company, implementing a policy which is consistent with the feedback we'd had from shareholders. I think also just looking at the discount and what Saba do, I know they've claimed they've closed our discount, but I think that does not take into account the strong performance that we've had over the last couple of years. And also, the very much improved business backdrop for our style of investment and investment focus in the US. And that's been particularly underpinned by the Trump election.
Okay, so obviously, as a board member, you're independent to Baillie Gifford, which makes all the investment decisions. Now, obviously, that independence is actually one of the advantages of the investment trust structure. Saba wants to be a big shareholder, and it wants to have the management mandate. So, do you think it's a dangerous situation for others? Investors in this trust, if Saba wins and it becomes the big shareholder and the investment trust manager?
Absolutely. As you say, you've got an independent board at the moment, and it's also a board which has diversified skill sets. And we are very aware that our responsibilities are to act in the interests of shareholders as a whole and not any particular shareholder. What Saba are proposing is effectively to install 2 directors who are closely connected with them, with a mandate to review the strategy and investment management arrangements. But Saba clearly have indicated that they want to be appointed as manager and to radically change the strategy. So the vehicle with Saba's proposals is going to be materially different to what investors invested in at the outset, and without any independent board to hold Saba to account.
Okay. Well, I mean, Saba's a hedge fund, a type of investor who typically cares about the short term, but investment trusts are long-term investment vehicles. So I guess if Saba wins the vote, do you think it would just try and push for short-term returns, and then once it's made a bit of money, potentially bring in a different manager again and then sell out?
It's difficult to know what Saba's intentions are in that regard. The only thing they have been public on is their desire to be appointed as manager and change the strategy. Apart from that, they provided absolutely no details of what their intentions are with regard to the company, and that includes even down to matters such as the costs, i.e. the fees which they expect to charge if they manage it. And I think that lack of detail, the conflicts that are resulting from what they're proposing, is why we are urging shareholders that they vote against the Saba proposals. And in that regard, it is really important. Every vote is going to count. It doesn't matter how big or small the holding is. And therefore, we would encourage all shareholders to vote so they have a say in the future of their company.
Okay, so thanks very much there to Sue Inglis for coming on the show. So just to reiterate, if you're a retail investor holding shares in these effective trusts, don't forget to read up on what Saba is proposing, and please do go ahead, cast your vote. Obviously, you are a part owner of these investment trusts as a shareholder. It's important for you to have your say. Right, so let's move on to energy bills. Obviously, that's something we all keep a close eye on. Now, the latest energy price cap is now in place. And of course, that raises lots of questions for people. First of all, like how much I'm now going to be expected to pay for an average household energy bill. So, Charlene, what's exactly been going on here?
Yeah, so the latest quarterly energy price cap came into force on New Year's Day, and that actually went up 1.2% compared to the last quarter. Now, that doesn't maybe sound like a lot in isolation, but it comes off the back of a really chunky 10% rise back in October last year. Scrapped winter fuel payments for some people, and now the fact we're slap bang in the middle of a really cold snap. As we're recording, it's -4 here in Cheshire, and it's just stopped snowing again. I've actually had school closures to contend with as well this week. So whilst we had known that those figures were announced back in October, it's just kind of highlighting the rise in typical energy bills for people on those kind of standard variable tariffs might be facing. Now, of course, if you'd fixed your energy price earlier last year, then you won't necessarily be subject to this increase, but it's just kind of something to bear in mind as we're sort of in this really cold weather. Now, in addition to that, we were expecting a dip in the energy price cap going forward to April, and hopefully some better weather. But forecasters at Cornwall Insights are now actually predicting another small rise in the maximum prices, this time of around 3%. So that translates to about an extra £217 for the average household, but obviously more if you have a bigger property to power. Like I say, we might hopefully see an improvement in the weather to mitigate some of the heating bill rise, but that remains to be seen. Now, these are forecasts after all. So, Cornwall Insights have gone from saying that they were expecting a dip to a rise. And, we mentioned the word volatility earlier in the podcast, and that really is the kind of the theme of running through everything, it feels like, at the moment. And kind of in energy, well, what's behind it all? More of the same, really. Volatility in international energy markets. So that's everything from the end of this transit deal for Russian gas to flow via the Ukraine, to kind of uncertainty about EU gas storage facilities. And again, what does a second Trump term mean for gas exports in the US? Like I say, it is just a forecast, though, and even those experts doing the forecasting are saying that things can change very quickly because of that volatility. Silver lining, some potential good news, though, particularly for lower income households. Ofgem is consulting on introducing an option to include zero standing charge options alongside existing tariffs, which offers more consumer choice, which is always great. But standing charges can make up a big proportion of bills for those in lower income households. So, having that choice and being able to move to a tariff where, perhaps the unit price is going to look higher, potentially a lot higher than they're currently on, getting rid of those standing charges, that kind of fixed cost might offer an improvement for some people in their cost. But like I said, that's a consultation at the moment.
Brilliant. Well, Charlene, thanks ever so much for that. So let's move our attention on to the high street. A lot of stuff going on. Obviously, people still watching their pennies very closely. So, Charlene, what on a sort of top level, what was happening in the retail sector as sort of 2024 was coming to an end?
Yeah, so we've had some figures from Barclays from December card spending, and they paint like an interesting picture of what's going on. So in December, card spending actually stalled, becoming significantly lower than inflation if you look past back over the year. So card spending pretty much the same level it was the year before. Inflation, if we're measuring it by CPI without those household costs, it was about 3.1% over that same year. What was behind this? Well, Barclays described joy-seeking Brits as prioritising entertainment and travel over essentials, which, may or may not be a surprise for December and the Christmas period. So essentials, people spent less on essentials, in large part, to lower petrol costs at the pump. But there was still evidence of households cutting back on essentials in favour of Christmas splurges on just kind of having fun, really. And what was behind that? Well, Wicked, for those musical fans and cinema fans, that actually accounted for cinemas enjoying spending of 52.1% more than the same period last year, thanks to those festive trips to see films like Wicked. And actually the small screen as well. So we're talking about the weather before, storms in December. kind of encouraged a lot of us to maybe not visit the high street and actually tune into the telly. So TV hits such as Black Doves, which I really enjoyed, if you're into that kind of spy thing. Day of the Jackal, I've not watched myself, but I've heard lots of people talk about it, and they help deliver really strong growth for those kind of digital content subscriptions. That was up 7.5% compared to December last year. And actually, we've talked about subscription services before on the pod, and a fifth, or just less than a fifth, actually 18% of Brits reported using their subscriptions to content such as Netflix more than usual, especially as, they were pushing out a lot of new content. Now, restaurants, pubs and bars and clubs saw just modest interest increases, as, people maybe limited socializing amid what Barclays are calling the quaddemic, so we're talking about costs of living. I'm sort of rolling my eyes as I say that, illnesses we have seen, obviously the seasonal flu and other viruses kind of really causing issues for kind of hospital and people's well-being. That has also boosted sales for things like pharmacies and health and beauty as well. And travel continued a bit of a strong performance. So in December, it was up spending on travel was up 4.7%. Again, that stormy weather and, these snow forecasts that came in that we're experiencing now meant that people were booking, last minute trips, whether that was to get some more snow on a ski trip or, those sunny escapes later in the year. And definitely part of that one myself. So yeah, it's an interesting picture. That's kind of painting a general picture, obviously, on what people were spending on. But Tom, I know you're going to give us a little bit more detail on some of our best known retailers and how they fared sort of over that Christmas period.
Yeah, absolutely. Because we've had sort of a good portion of the big retailers report now. So to back up what you were saying, Charlene, definitely, I mean, if you're being generous, I guess you could say that the performance has been mixed. We actually got off to a reasonably good start in terms of the sort of Christmas reporting season for retailers. Next issued an upgrade for its current financial year, which is nearly over now. That's kind of at the end of January, off the back of a pretty robust Christmas performance. And it's on course to join what is a rather exclusive £1 billion profits retail club in the UK. But there were some signs in its own statement of how challenging things are for retailers and sort of for some of the problems that we've seen in its peers since. So guidance for the year to January 2026 was a bit short of what the market expected at Next. It highlighted £73 million worth of extra budget-related costs and said these wouldn't be completely offset. And a key theme, which has sort of been repeated elsewhere, is that, as you were saying, partly perhaps down to the weather, high street activity, so people actually going into stores, has been down and it's trailed kind of online sales. So online sales have had to sort of pick up the slack a bit. Now, what was I to be honest, when I first saw Next statement, particularly because of the outlook, I'd have expected the shares to be down in reaction to it, but the shares actually went up. And I think that might have been because Next is often known for being quite conservative about the outlook in order to sort of set itself a reasonably low bar that it can then clear. It's very good at managing expectations. But if Next got a fairly generous response to its updates, the opposite was true for Tesco, Marks and Spencer, and B&M, the value chain as well. So they all came out with numbers on the day we're recording, so on Thursday, the 9th of January. And none of them were terrible trading updates by any means. They were reasonably resilient, but they all got smashed up by the market to various degrees. They picked a bad day probably to report because, as we were discussing earlier on, obviously you've got this situation where UK gilt yields are surging, the pound is weak, the sentiment towards the UK is very weak, and because the retail sector is, almost entirely dependent on the domestic economy, that's not going to be very helpful. Tesco didn't fall as much as the others. there were some sort of negatives, but there were some positives as well in their statement. So they achieved some fairly material market share gains in the 3 months leading up to the 4th of January. There was a decline in the level of revenue growth compared with the previous year, but whilst there is still inflation, it is lower than it was then. There weren't any upgrades in alongside sort of Tesco's results, and that may have created a bit of disappointment. But it's been, I think, being quite competitive on price. It wants to, and that has paid off in terms of higher market share. It employed a lot of extra people over Christmas, and presumably because it wanted to make sure that sort of customer service was good. And I think you could look at that as kind of in the short term. It's brought on some extra cost. It's kind of cut prices, and so that will affect profit. But that might be a good thing if in the long term, it's improved its competitive position. The wholesale division was a bit weak, partly kind of due to declining tobacco sales and some fairly kind of weak or soft showing in the fast food sector, which it serves through a logistics operation. Marks and Spencer did pretty well on food. I mean, food's been kind of a strong area for that business for a long time. It seems to be kind of offering a bit more value to people, and that's been well received. But the theme we were talking about earlier, it saw a decline in in-store clothing sales, and that was only kind of partially made up for by online sales. Interestingly, I mean, we're talking about the domestic pressures. Its international operations didn't exactly do well, and if you looked at the outlook statement, it was pretty gloomy. They were talking about all the things we've just been discussing. So the impact of the budget, the fact that inflation is still persistent, that rates are kind of proving to be higher than for longer than previously been expected. And I suppose, unlike Tesco, which, I guess, is largely non-discretionary, a lot of it is just people buying their weekly shop. Marks and Spencer is a bit more reliant on discretionary spending because it's got, a bigger footprint in non-food categories. B&M, which I mentioned, also pretty weak. And it's interesting, I think, they're obviously a value chain. You'd think if things are a bit tough, people might trade down, but that doesn't seem to be carrying through. And although they announced 150 million special dividend, that did little to appease investors, really. And then just finally, and kind of staying, I suppose, on the value theme, Greggs results also got a pretty tough reception. So there was further evidence of slowing sales there. There were downgrades to forecasts in the wake of its statement. Interestingly, there was signs of a bit of outrage online that their sausage rolls have got more expensive. So it shows that they face a real pressure a real balancing act to deal with higher costs that are coming through, but without alienating their sort of customer base who expects, the food to be cheap. That's a key selling point for them.
Well, it's £1.30, isn't it, Tom? This is the magic number.
£1.30, yeah. Which to me, it doesn't sound outrageous, but I guess the key part of the appeal of Greggs is that it's cheap hot food on the go, and if their price of it is starting to creep up, you can see that people might they might not bother with that sausage roll. So that's tricky, and Greggs is, because it's got a good track record, it's often traded on quite a high valuation, and given the sort of broader weak outlook and backdrop for the retail sector, that could be under some threat.
My take from all this is that it's not a case of the outlook's gloomy, everyone's just going to buy stuff as cheap as possible. It's people are spending money where they think they feel like they're getting good value for their money. So Aldi was talking about a big increase in premium range products. Next was talking about, actually, it wasn't really selling as many of the sort of the basic stuff, where the average amount of money people were spending was more, but they're buying fewer items. So it suggested that they want to buy something that's decent quality that will last. I think, everyone talks about Greggs sausage roll being this great thing, but actually, when was it? You just cast your mind to the last time you bought one. in most of these shops these days, they're sort of lukewarm. And, are they the best thing since sliced bread? I don't know.
Oh, I don't know. I mean, have you had a disappointing sausage from a Christmas market and paid over like a tenner for it? I think it's No, I get what you mean about these kind of like what I'd call considered purchases. People really thinking about buying one good quality thing rather than a load of cheaper stuff. Maybe not such a bad thing for waste, and people getting stuff on Vinted and things. But yeah, it's hard, isn't it? We don't want to be too gloomy, but the reality is there in those figures from those best known retailers.
Yeah. Well, brilliant. Tom, Charlene, thanks for covering the retail stuff. So it's really interesting stuff there. So we switch our attention now to lifetime ISA. So, I mean, certainly for me, it was out of the blue. Government sort of said, "Oh, we're going to do a review of the lifetime ISA." I didn't see that coming. What, Charlene, did you think this is always was going to be in the pipeline that they were going to have a good look, or were you surprised?
A little surprised, especially kind of so early in the new year. And, we've heard about those letters landing on different government departments' doormats asking for kind of boosts to growth. So yeah, kind of an interesting one and slightly unexpected, but quite welcome, really. So what is going on? The Treasury Committee, so quite an influential body, within government, have this week launched what they call a call for evidence focused on the lifetime ISA. Now, the lifetime ISA came along in 2017. Quick recap, it offers an upfront bonus and tax-free access for a first property purchase and also from age 60 for investors. So it's available for the first time for people between age 18 and 39. And it can be quite an attractive product for aspiring homeowners and actually some retirement savers too, because of that ability to access it tax-free from age 60. We haven't seen the first people be able to do that just yet because of when it came in and those age limits. But, there are areas where, we particularly at AJ Bell feel that it could be reformed. And those two are the early withdrawal charge. So there is a government penalty charge for people who take their money out and don't use it to fund their first time property purchase, or the property doesn't quite meet the rules, or they do for another reason, before age 60. There's also a maximum price, there's various rules about what that property for the first time buyers can be priced at. So it's 450,000 is the maximum price. And, that has been the same since the product was launched back in 2017. And we all know that, property prices aren't the same as they were back in 2017. So, it's really welcome. They're asking kind of a series of questions about the lifetime ISA, how it's set up, how it's delivered, how popular it is, and obviously those features that I've just mentioned. So as we say, they can be a really attractive way for people to invest in specific circumstances. So building that deposit for the first home and, and also enjoying kind of tax-free investment that we're used to with conventional ISAs. The additional flexibility, as I mentioned, for those saving for retirement. So it could be another option alongside a pension, or for self-employed savers who don't benefit from auto-enrollment and employer contributions. It can be kind of an attractive alternative to traditional pension products, where we've seen, some self-employed people just kind of turn off from retirement saving altogether. But, the message is we feel that lifetime ISAs could get a bit of an improvement, and hopefully, this review from the Treasury Committee is a good opportunity to address kind of some of those issues with design. Of course, it's just a call for evidence. It doesn't necessarily mean that anything's going to kind of happen, and certainly not in the short term. We have, regular listeners will know we've long campaigned for a reduction to that early withdrawal charge from the government. It's set at 25%, but it actually doesn't just reclaim any bonus a saver might have or an investor might have had. It actually penalizes them for taking their money out over and above, meaning that they can get a lot less than they put back in if they do actually take their money out early. That happened in the pandemic. The charge was reduced to 20%, which is more realistic, recoups that bonus and doesn't have that extra penalty. So it's kind of like, why could we not maybe go back to that point? And, we've also highlighted quite recently, Dan, you did some great analysis on this about how first-time buyers are being frozen out due to the maximum property price limit being the same as it was back in 2017. So in some areas, particularly in the southeast, people wouldn't necessarily be able to use the lifetime ISA to buy their kind of dream first home because it's crept over that £450,000 limit. So, welcome review as perhaps a little surprise. Obviously, we will be responding, and making representations. So, yeah, kind of watch this space over the medium term, I guess.
Brilliant. Well, thank you ever so much, Charlene, for that analysis. It's really good. So shall we bring on our final guest of the week?
Yeah. So you might be kind of more familiar with the name Octopus for energy business, as we've talked about energy in the pod already. But the company also has a large investment arm, and one of its funds specializes in, the future. So the premise of the Octopus UK Future Generations Fund is to invest in companies that can, it says, change the world for the better. Now, such ideals haven't always gone hand in hand with returns for investors, and especially the case kind of as interest rates were beginning to shoot up. So Danni Hewson, our very own Danny, caught up with lead fund manager Dominic Weller and asks how he was feeling about the outlook for this year, 2025 and beyond.
Thanks so much for talking to us, Dominic. For those who haven't come across Octopus Investments, and in particular the Future Generations Fund, can you just briefly explain who you are?
Yes, absolutely. Thank you so much that you're having me on this morning. Most people will know Octopus as Octopus Energy, which is part of our group. Less people know that we are a specialist asset manager as well, which was set up in 2004 by 3 young entrepreneurs, and has grown from there. So it's focusing on venture capital, on real estate, on renewable energy, and we have a quoted business as well, which is the part I'm working in. I've been with Octopus now for almost 10 years. And 3 years ago, I launched a fund called the FP Octopus UK Future Generations Fund, which has been really an exciting journey for me. It's a UK-focused fund, investing across the market cap scale from really small companies to really large companies. And the key idea and philosophy behind the fund is that by solving really important problems, businesses can have a positive outcome on society and planet while also serving shareholders. That's sort of the key idea behind it. We're investing in 3 areas, which are building a sustainable planet, empowering people, and revitalizing healthcare, and finding amazing management teams in those sectors looking to tackle challenges. And it was really a passion of mine to invest money in that way. I wanted to invest my money, my family's money that way. And I feel very lucky that now we've got a little fund going and have the ability to invest in these companies. And that's sort of who I am and where we are.
So investing for that kind of change that you were just talking about, it seemed to have been all the rage a few years ago. It's less talked about now. It feels like it's lost its shine a bit. Has that been down to performance?
I think there are a few factors that have played into that. So on the one hand, you've had a lot of these assets that are looking for change are quite correlated to low interest rates because they're in their nature. Sort of trying to do things in the future, investing and heavily benefiting through it. So when we went through an interest rate hiking cycle, and that had a very negative impact on performance for a lot of these strategies, then I think the invasion of Ukraine in 22 had a big impact. So there's a lot of studies on funds focusing on those sorts of assets and the outflows they experienced following that. And I think those took some change in the market and the way investors thought about these themes. But my belief is that over the long term, this is cyclical, and these are challenges that will need to be solved ultimately. Sort of our healthcare system globally is something that will need to get solved. Our communications infrastructure, the way, climate change as a larger thing, how we get energy security while at the same time stop the planet from warming. I think these are challenges that won't go away and will continue to provide opportunities for investors in the long term. So I'm quite positive on it, especially as we enter a period of potentially lower interest rates again.
And huge change as well. We've got a new government coming in. There's been a big focus on some of the negatives that have come out, particularly from Rachel Reeves' budget. And I want to talk to you about national insurance in a moment. But the government has committed to increasing spend on things like healthcare, on things like green energy transitions. Is that cause for optimism?
I believe so. I think a lot of governments globally have set very ambitious goals towards the energy transition, and the UK government is part of that as well. We've seen investment by the UK Infrastructure Bank into portfolio companies, which has been a real positive, I think, to inflect capital there. And definitely, these technologies did need government support, which they've got, and a lot of these technologies are now maturing and sort of competitive globally, which is a great place to be in the long term. And I think the way we look at these is on a technology by technology and on a global scale. So looking at renewable energy, splitting it into solar and into wind and other technologies. We're looking at energy storage, batteries, long duration, short duration, solid state, and then hydrogen as a key theme, and really trying to understand what are the agendas there and which companies have a right to win potentially in that space. And I think it's always hard to invest purely based on government support. I think you need to have credible investment cases where the businesses can forge their way in a competitive market and have a right to win. And that's the sort of businesses we're trying to look for.
So we're right at the start of 2025. We've got the year opening up ahead of us. A lot of change, as I say, coming along, not least the inauguration in just a couple of weeks of Donald Trump. He said just a few days ago that the UK should be ditching its windmills. How do you think having Donald Trump back in the White House might impact that area and some of the companies that you have in your fund?
It was interesting. I think just yesterday, the UK wind was the biggest power source in the UK for the first time ever, which is quite remarkable. I think Donald Trump is a big factor, I think, for businesses that they're going to have to manage, be it through tariffs or other policies that might be out there. But businesses have to manage through these changes, and we want management teams that sort of are proactive and create opportunities out of these factors, which is what we've seen through different times of changes, be it the pandemic, be it through changes in interest rate policies or in terms of global trade changes. So, yeah, I think it is just part of investing in this landscape, and it's currently a time of slightly higher uncertainty in terms of the US because a lot of the policies are just not quite clear yet, be it in healthcare, which has caused a lot of volatility, be it in, as you say, infrastructure and renewable energy. But I think it'll create opportunities in the long term, and that's the way we see it. And look to find businesses that can win regardless of the backdrop.
Let's focus in on the UK now. I mentioned national insurance increases in employer contributions. You don't invest in some of the sectors which are saying that they're going to be hit the hardest, like hospitality and retail, but there must be some headwinds there.
Well, it could potentially have an inflationary aspect, but when we're going through our portfolio companies and talk to management teams, as you say, labor cost is a very substantial part of the businesses that we're investing in. So the average employee earns a lot of money relative to the average company, given they're quite knowledge intensive, and so we don't see it as a significant headwind for our portfolio companies by and large. It also, the businesses we invest in tend to have very strong gross margin structures and operating margin structures, meaning that they have a level of pricing power, a significant competitive advantage in what they're doing. And so we would hope that they can manage a dynamic like the national insurance increases better than businesses and sectors where they're exposed differently. Often a lot of the companies we're invested in are also international in terms of their labor force and quite international in that space. So we would not expect it to have a material impact on the fund in this case.
You do invest in a lot of smaller companies. I need to ask you about changes to IHT announced in the budget. Has that had any impact on inflows, outflows?
Well, I think UK funds and UK small cap funds in general have been in a very negative flow environment for a very long time. I think if you plot the chart since Brexit, people have been taking money out of the UK and especially UK small caps. So it's been a painful process for these smaller companies. And sort of the US pull of capital has been quite powerful. I do think that there is a political consensus that a vibrant equity market is really important, and it's important for the economy and important for the treasury. And so I think that there is a strong incentive to fix that, and I think business property relief or IHT changes, they are one part of that puzzle, but I think it will take a look into capital markets reform, and have a look at pensions, and there's been a lot of speculation around how pensions are going to look towards UK assets, and I think it'll require a wholesale it'll require an overall look on this into this ecosystem. But I think there is a lot of incentive and a lot of understanding, and a lot of smart people looking at this, trying to sort of figure it out. And I'm quite positive on that.
Let's end sort of putting your hat on, your crystal ball out, having a gaze into what 2025 might have to offer. How do you make sure that investors are getting good returns as well as having good intentions?
Well, we look at our investment universe and find businesses which are solving really important problems within our themes, and then we overlay that with our investment philosophy. So looking for businesses which have the ability to reinvest capital, which have a value creating business model, strong margins, strong balance sheets, and so find businesses that are really well equipped to capitalize on the opportunity. Now, looking into 2025. We think we're nicely positioned. The businesses have great opportunities ahead of them. And by focusing on the problems that they're solving and the importance of the problems they're solving, we think we're positioning the portfolio in a way where they can have positive outcomes for people and planet, but also can thrive over the long term. So that's really the way we look at it.
Dominic, it's been great talking to you. Thank you so much for your time.
No, thank you so much for having me. It was great fun.
Well, that was Dominic Weller from the Octopus UK Future Generations Fund. So some really great insights there. So obviously really good to hear from these experts to get different perspectives about where things might be headed.
Yeah, and kind of with that, we're going to wrap up today's episode. So thank you so much for tuning in for our first pod of the new year. Please don't forget to subscribe and leave us a review. It really helps others find the podcast and make sure that we're kind of giving you the content that you want.
If you've got any questions or any topics you'd like us to cover, drop us an email. It's podcast@ajbell.co.uk. We'd love to hear from you. So next time, we'll hopefully be talking to an expert about all things Asia related. So until then, thank you very much for listening, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.